Welcome to Markets Now. I'm Michelle Rook along with Sean Hackett with Hackett Financial Advisors. And as we move through the mid-session, just about everything is to the plus side now. And Sean, let's talk about the grains. We are seeing a little bit of strength despite the fact that we have such a risk off in the outside markets. That seems like almost a victory today.
It is a victory, but we're seeing more and more days where it seems that commodities, especially agriculture commodities, have been breaking away from the outside markets after a year of correcting downward and driving a lot of speculators out of our markets. I think we're starting to get to some fundamental value where the cash market is starting to override these outside influences. And of course, we're getting into the critical time of the growing season where those factors matter more than what the outside factors are doing. So I think this is a kind of a good sign, and a sign that maybe we're going to get some better performance relatively speaking, especially in agriculture.
Yeah, let's hope we're divorcing ourselves from those outside markets. It's been a rough go, as you point out. Soybeans, we've had this rally on Argentina news. We went up, made contract highs in meal, and then we've kind of pulled off of those Monday highs here now. So is that story baked in, and what's the next story that this market needs?
I think it is baked in, for better or for worse. You can only trade a story for so long. Even though harvest in Brazil is slow, those supplies are starting to become more and more prevalent. I think the next big story, Michelle, is how many of these soybean acres are we going to plant this growing season?
Okay.
We talked about, how this renewable diesel, the need for more acres. I just think the market could get spooked when they start looking at the balance sheets and then maybe the acres that the USDA is suggesting we're going to plant and say these numbers simply do not work. I think that could be the next focal point or hotspot for what soybeans need to do between here and the spring to make sure they have enough acres and hopefully we have a good growing season.
But we have to get through this big Brazilian crop and harvest pressure from that first, don't we?
Absolutely. And that's definitely going to be an issue here for the next, let's say, 30 to 45 days. And that is going to be putting some pressure on. But quite frankly, given the short Argentina crop and what's going to happening here with renewable diesel later this year into 24, 25, every single bushel that Brazil is putting out there is actually needed in the global marketplace. So it can have a short-term impact, but I think the world and the demand, the buyers out there for soybeans are realizing, they better get it while the getting is good.
Right. So the crop ratings dropped pretty substantially in Argentina. 11% on the corn and I think 4% on the bean. So you say that's worked into the bean market, but is it worked into the corn market? And as well, are we still waiting to see what happens with the second crop safrinha corn?
I think when the market is looking at everything, if we get the big corn crop that everyone has been anticipating out of Brazil, then they're not going to worry too much about the short crop in Argentina.
Okay.
The key is delayed planting for two reasons: too much moisture, but another reason, Brazil's had the coolest growing season, third coolest growing season in 50 years. So their soybeans are developing late, and some of the delayed harvest is not due to wetness, is that the crop's not ready to be harvested. So I actually do not believe we're going to be able to get the corn crop planted on time, which means we push pollination out into the April, May timeframe, which, as you know, Michelle, is their dry season. So I really think as this market gets further on into the season, that big record-setting crop's going to be pushed back down, and that's when the Argentina shortfall becomes more of an impact to the market. It's not a mover today, but it could be a mover, let's say 30 days from now, I think, in the minds of the market.
Something to keep our eyes on, and that could get us finally above these resistance levels we keep hitting our head on. What about the wheat market? We are seeing a little firmness there again today. Black Sea export concerns, is that part of what's driving it? Because you would think we might be down today, especially with this big rally in the dollar.
Well, we're coming up for another renewal, right, on the
Right.
corridor deal. And there's a lot of talk, given the escalation of unrest and war going on between Russia and Ukraine, that the likelihood of that deal being renewed is getting less and less likely by the day. If we lose that corridor deal and we shut off Ukraine again, and you throw in any kind of worries of whether in Russia or in the U.S., during post-dormancy season, the market is mispriced here. And so I think the market is getting a little worried that it might need to put some risk premium on here in the winter wheat market to kind of capture or anticipate some of these drivers that could really shock the market back up again after a long period of kind of indifference.
Well, we don't have a lot of war premium in there, as you point out, but I'm wondering, I'm reading that Russia may want that corridor open just so that they can export to China. Is that a factor?
Well, it's complicated. I mean, I think they could still move a lot of grain without the corridor deal, but at the same time, they want to win the war, right? So they have to balance a lot of factors here about selling wheat and to China versus winning the war. And I think leverage with food, not only with Ukraine, but with NATO, is a bargaining chip that at some point I think they want to play, because I think they want to put this, they want to start getting the upper hand here. And, obviously food is a great chip that they have to play. I'm feeling that they want to start playing that for right now, and they'll worry about selling more wheat later on in the year.
Gotcha. And obviously a close back above the $9 mark in Kansas City wheat would be positive for this week, but Chicago wheat is yet to get across that $8 mark. That's been pretty stiff resistance.
It has been stiff resistance, but I actually think we will get over that hump.
Okay.
When I look at, we're dealing with this significant, they call sudden stratospheric warming event in the atmosphere right now, Michelle. One of the strongest events we've seen in 30 or 40 years, and that tends to bring a very increased probability of these extreme cold shots down from the Arctic region that could come in just as we're coming out of dormancy and potentially, add another blow to the winter wheat crop, both SRW and HRW. So we really need to be watching these March weather maps, because these sudden stratospheric warming events can come out of nowhere and create these big undulating, incredible cold, 7-day events that really could clip this crop going into the important spring season. So I think that's a big risk factor. The market probably needs to start putting some weather premium in now that we have this event that's clearly underway.
One market that has not been able to divorce itself or shake off the outside market negativity this morning has been the cotton market, and we had a down day yesterday, but that market has renewed concerns here after the CPI and the PPI data and inflation concerns again, right?
Yeah, I mean, it's one of the few ag markets that's extremely economically sensitive. It's also sensitive to the price of crude oil, because obviously cotton competes with synthetic fibers,
right,
for demand. And so when crude oil continues to be unable to get out of the low to mid $70 barrel area, it's just not helpful when the market is looking at the Federal Reserve and they continue to say they're not done yet. They're not done yet. It just brings sellers back into the marketplace and keeps buyers saying, why should I jump the gun right now and buy when it looks like we'll have some more opportunities later in the spring? So it's a market that's just struggling to try to find its footing, given those two factors.
So the CPI and the PPI data, did that give the Fed enough ammunition to accelerate the interest rate hikes here in 2013, or did they have to get confirmation from the PCE or what?
I don't think it makes it accelerate. I think it keeps them on track to keep increasing interest rates. Remember, they already throttled down, and I think they're going to stay at a lower increase, but it sure gives them every reason to continue to raise rates at the next Fed meeting and not stop, I guess is what I'm getting at. And if you believe what he said in the last meeting, they're not done at the next one. They got 2 or 3 more to go before they may be on hold. And that's still a lot of time and a lot of rate increases and a lot of damage that can be done to economic demand before the market starts to get a breather here. So that's going to continue to weigh on economically sensitive commodities like cotton for at least the next 30 to 45 days, I would say.
Okay, the cattle market has shook that off pretty well, obviously. We are seeing the market back up today, but what are the signs that you're looking for that market might be getting close to a top here? Because cash trade has been bullish. We're up $15 on the choice boxes here in the last couple of weeks. So, what is it going to take to turn that market?
Well, what we've been seeing in most markets, Michelle, is it holds up, the demand holds up, and then it just caves in. Whether it's the dairy industry, whether it's the pork industry, whether whether it's lumber, we see demand all of a sudden just hit an air pocket, And so I think we need to be on the lookout when the cash trade, like you just said, just 1 week just falls out of bed out of nowhere, and then the speculators see blood in the streets and kind of get their feeling that this market is in is made at least an intermediate top. And we certainly would be looking for cash to cave in here. I'm expecting to see that. I've been a little early on that forecast, as you know, Michelle, but I still think that the risks to me at this price level are to the downside with that coming, especially with the Fed continuing to be putting more and more pressure on end user demand. I really find it hard to imagine that we can hold up for the next 2 to 3 months in beef prices this high. I think we have to trade an air pocket first before we get on the other side when the supplies are so low that even weaker demand won't be enough to stop the market from going higher.
All right. Well, the cattle guys are going to argue with you just because we're not into the tightest numbers yet. So we'll see what bears out there, as always. Thanks so much, Sean Hackett with Hackett Financial Advisors, and that's Markets Now.